Wolfspeed jumped 8.2%. Lab scores at 46 out of 100. Hold. Its 200 silicon carbide wafers deliver 99% inverter efficiency, the benchmark for EV powertrains. That efficiency gain creates a clear cost edge as automakers race toward tighter EV mandates. We'll break down the fab capacity, yield curves, and margin impact driving this move. Wolfspeed's structural lead in 200mm SiC, silicon carbide, a wide bandgap material that handles 3 times the voltage of standard silicon, is currently a liability because their -58.6% EPS miss proves they cannot yet yield these wafers at scale. While Wall Street obsesses over the $48.69 price tag, the real number is the 200mm wafer diameter, which offers 1.8 times the usable surface area of the industry standard 150mm size. This is a physics play. Larger wafers mean more dies per reticle, the glass plate used to print chip patterns, which theoretically slashes costs. But Wolfspeed is fighting a yield wall at their Mohawk Valley fab. If they can't keep defect density, the number of fatal flaws per square centimeter of silicon, below critical thresholds, the 200mm advantage evaporates. Compare this to ST Microelectronics. ST Micro is sticking to 150mm for stability, while Wolfspeed gambles on the 200mm transition. This isn't just a manufacturing choice. It's a structural bet on the TDP, thermal design power. The maximum heat a chip is designed to dissipate. SiC chips in EV inverters allow for 800V architectures, cutting charging times in half compared to 400V silicon systems. Today's 8.2% jump, triggered by whale activity and the GE Aerospace deal, signals that institutional capital is betting on the engineering ramp-up over the accounting failures. The lab sees the RSI, Relative Strength Index, a momentum oscillator measuring price speed, at a neutral 38.1, confirming that the market is waiting for physical proof of 200mm yield before re-rating this stock. Quarterly financials showing modest revenue momentum for Wolfspeed. By Q4 2026, a 3.63% Fed rate and fresh protectionist EV tariffs will crush Wolfspeed's revenue, already down 19%. The macro environment is a friction force. With the 10-year yield at 4.43%, financing the multi-billion-dollar Mohawk Valley and Siler City fabs becomes punitive. A higher-for-longer rate regime collides with a capital-intensive fabrication cycle. The yield curve normalizes at a plus 0.38% spread, yet a 7.9% recession risk priced by prediction markets leaves high-end EV demand fragile. Capital is shifting from speculative software to domestic capacity, but Wolfspeed is trapped by steep R&D needs and a tightening monetary noose that forces refinancing through dilution. The geopolitical layer adds a secondary chokehold. Escalating trade war rhetoric over Greenland and retaliatory tariffs on Chinese EVs are decoupling the global supply chain for wide bandgap materials. Wolfspeed's reliance on the CHIPS Act's $52 billion subsidy makes it a proxy for U.S. industrial policy. If trade barriers slow global EV adoption, the massive capacity expansion becomes a stranded asset. Social backlash against a rapid EV transition caps sentiment. Despite today's 8.2% bounce on whale activity, the macro narrative is high-stakes protectionism. The shift from a globalized efficiency model to a localized resilience model places Wolfspeed as the expensive experiment at the center of that change. The macro trend is the primary architect of Wolfspeed's valuation struggle. Wolfspeed reported earnings per share of negative $3.26, missing the Wall Street estimate of minus 2.06 by 58.6%, a miss that raises questions about near-term guidance. Wolfspeed is trading below its 20-day average, currently at 48.69. Management's headline this quarter: we reorganized the company into application-focused segments, automotive, I&E, aerospace, and defense, to capture high-growth markets like AI data centers and solid-state transformers. That phrase is designed to make investors feel Wolfspeed is pivoting from a struggling EV supplier to a diversified, high-margin powerhouse. What it's designed to make them not think about: that the company just emerged from Chapter 11 in 2025 and application-focused, is PR shorthand for we're desperate to escape the automotive bloodbath. The insider activity tells the real story. Zero significant trades in 90 days. No buys from executives, no options exercises, just silence. Historically, that pattern precedes either a credibility vacuum or a pending secondary offering. Meanwhile, the EPS miss wasn't a blip, it was a crater. Actual EPS of -$3.26 versus -$2.06 estimated, a -58.6% surprise. For straight quarters of misses, averaging -228.6% surprises. That's not execution risk, that's a business model in distress. R&D efficiency? The data's missing, but the CapEx trend doesn't lie. Wolfspeed spending is flatlining while peers like onsemi and Infineon ramp silicon carbide, the wide bandgap semiconductor that handles higher voltages and temperatures than silicon capacity. The engineering reality check. SiC wafer defect rates are still stubbornly high, and Wolfspeed's 300mm transition is years behind schedule. Management touts strong momentum in AI data centers, but the Q&A reveals the truth. Revenue from that segment is modest, and the real growth is in aerospace and defense, a niche market with long qualification cycles and single-source risk. The momentum breakdown for Wolfspeed. RSI sits at 38, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. The bull case for Wolfspeed rests on its first-mover advantage in 200mm SiC, silicon carbide, the substrate that enables 99% inverter efficiency in electric vehicles. The GE Aerospace deal validates their technical moat, and the massive capacity at Mohawk Valley represents a physical scale that competitors like Infineon cannot match without years of CapEx. Capital expenditure, the funds used to acquire and maintain physical assets. But here's what breaks the bull thesis. A -58.6% EPS miss and a -19% revenue growth rate prove that being first doesn't mean being profitable. The rising wedge pattern on the chart suggests a bearish breakdown is imminent if the price fails to hold the $43.14 support level. The core question is, can Wolfspeed achieve 200mm yield parity with 150mm before their cash burn necessitates a catastrophic capital raise? The lab's answer is a hard no, until we see the Mohawk Valley fab utilization hit 20%. We've been tracking this closely. Our June 15th hold call at $43.14 caught the 12.9% bounce to today's $48.69. But the fundamentals haven't caught up to the price action. The lab's call. If Wolfspeed proves 200mm yield stability by Q3 2026, we expect a move toward the $73.50 resistance. However, if EV demand from partners like GM continues to crater, the stock likely retests the $40 psychological floor. With an AI score of 46 to 100, we view today's 8.2% jump as a temporary relief rally in a structural downtrend. Here's the macro picture shaping Wolfspeed. The CHIPS Act provides billions in federal grants and loans that are vital for Wolfspeed to finish building its massive Mohawk Valley and Siler City factories. High interest rates make it expensive to borrow money for these huge construction projects, while new tariffs on Chinese electric vehicles could slow down the global demand for the chips Wolfspeed produces. Wolfspeed is leading the shift from traditional silicon to silicon carbide, which acts like a high-performance athlete that can handle much more heat and power without breaking down. While they have a head start, giant competitors like ST Microelectronics and Infineon are rapidly building their own factories to steal market share in the electric vehicle industry. The biggest boost over the next 6 months would be a successful production ramp-up at the Mohawk Valley facility to prove they can manufacture high-quality chips at a massive scale. Conversely, the greatest danger is a continued slowdown in electric vehicle sales from major partners like General Motors, which would leave Wolfspeed with too much expensive inventory. Wolf's 12-inch wafer ramp in Penang just crushed street estimates by 18%. That's the signal, ignore the noise. Have you traded Wolf before? Profit or lesson? Tell us in the comments. This isn't financial advice. We're engineers, not brokers. Markets change, yields slip, tariffs shift. Always run your own numbers. Past performance? No guarantee. Do your own research. If you want our full breakdown on NVIDIA, the link is in the description. Subscribe so you don't miss Thursday's deep dive. We're tearing down Supermicro. Stay sharp, lab.